For generations, buying a home was supposed to be one of the safest bets in America. Work hard, save money, get a mortgage, buy a house. But today, millions of Americans are discovering something unsettling. Even with a full-time job and a decent income, owning a home can feel completely out of reach. In 2026, the national homeownership rate sits around 65%, while affordability and limited supply continue to hold back new buyers. So what happened? Did houses simply become too expensive? Did mortgages break the American dream? Or did something much bigger change underneath the entire housing market? Because the strange part isn't just that homes cost more, it's that the entire system around buying a home has changed. And once you follow the money, the shortage, the interest rates, and the incentives, the housing crisis starts to look very different. The American housing problem is easy to describe with one number: price. But price is only the surface. The deeper problem is that several forces collided at the same time. Home prices climbed dramatically during and after the pandemic. Mortgage rates later moved much higher. Construction remained constrained, and many homeowners who locked in extremely low mortgage rates became reluctant to sell. That created a strange market. There are homes for sale, but many aren't affordable to the people who need them. A 2026 analysis by Realtor.com and the National Association of Realtors found that the alignment between available listings and household incomes was only 74.9% in March, compared with a pre-pandemic baseline of 84.4%. In other words, the problem isn't simply a lack of houses. It's a lack of houses ordinary buyers can actually afford. And that distinction changes everything, because when the affordable part of the market disappears, people don't simply stop buying. They rent longer, they move farther away, they live with family, they delay marriage or children, and some give up on homeownership altogether. The American dream hasn't disappeared, but the price of entering it has changed dramatically. To understand today's housing crisis, we have to go back. For decades, homeownership was closely tied to the idea of middle-class stability. A house wasn't just somewhere to live. It was a place to raise children, build savings, and eventually own an asset that could appreciate over time. But America's housing system was never static. Population grew, cities expanded, jobs moved, construction patterns changed, and local rules determined what could actually be built. Then came a long period of relatively cheap borrowing. Low mortgage rates made monthly payments easier to manage, even when prices were rising. The pandemic accelerated the transformation. Millions of Americans suddenly reconsidered where they wanted to live. Remote work changed demand. Buyers competed for limited inventory. Prices surged. Then the environment reversed. Interest rates climbed, making borrowing dramatically more expensive. But homeowners who had already secured very low mortgage rates faced a new calculation. Why sell a house with a mortgage around 3% and replace it with another mortgage around 6%? Many didn't. That created what economists call the mortgage rate lock-in effect. By early 2026, 5% of outstanding mortgages still carried rates of 3% or below, while nearly half were at 4% or less. So the market became trapped between expensive homes and owners unwilling to give up cheap loans. The first problem is simple. Houses became expensive, faster than many households could keep up. But there's another problem. hiding underneath. Not all housing supply is equally useful. Imagine a city suddenly builds thousands of homes. That sounds like a solution, but if most of those homes are luxury apartments or expensive single-family houses, a teacher, nurse, young professional, or first-time buyer may still have nowhere affordable to go. That is the housing mismatch. Realtor, COM, and NAR found that lower and middle-income households face particularly severe shortages of listings within their price range. Then, there is the cost of borrowing. A mortgage doesn't just determine whether you can buy, it determines how much house your income can support every month. In June 2026, Realtor COM reported a national median asking price of about $430,000. At a 49% mortgage rate with 20% down, the estimated monthly payment was about $2,172 before accounting for other ownership costs. Add property taxes, insurance, maintenance, utilities. Suddenly, the purchase price isn't the real price. The real price is the monthly commitment, and that monthly commitment is what shuts millions of potential buyers out. Then came the moment that changed the math. Interest rates rose. For someone buying a house, the difference between a low mortgage rate and a high one can completely transform the monthly payment. And unlike the sticker price of a house, interest is paid repeatedly over decades. That meant buyers suddenly had to spend far more each month for the same property. At the same time, existing homeowners were sitting on mortgages that were dramatically cheaper. The result was a market with two very different groups: those who already owned and those who wanted to enter. The first group had an incentive to stay. The second group faced higher borrowing costs. This is why simply saying housing prices need to fall misses part of the story. If prices fall but mortgage rates remain high, affordability may improve only partially. If rates fall but home prices remain high, monthly payments can still be painful. And if rates fall sharply, more buyers may return, potentially pushing prices upward again if supply doesn't respond. That is the trap. The market is balancing several forces at once. In early 2026, home purchase lending fell to its lowest quarterly level since early 2014. According to Atom data reported by Realtor COM. But interest rates aren't the entire story. The deeper issue is supply. Freddie Mac estimated in late 2024 that the United States was still short roughly 7 million housing units compared with long-run demand. And housing supply doesn't appear overnight. A new home requires land, permits, infrastructure, labor, materials, financing, and local approval. Every one of those steps can slow construction. This creates a fundamental economic problem. When demand grows faster than supply, prices face upward pressure, and America's housing shortage has been building for years. Even when millions of new homes were added, demand kept absorbing much of that increase. There is another complication. A house isn't mobile. You can't simply manufacture housing in one state and ship it to a city where demand is highest. Jobs determine where people want to live. Transportation matters. Schools matter. Neighborhoods matter. So a national housing shortage can actually contain hundreds of local shortages. One city may have enough homes. Another may have too few. One region may be relatively affordable. Another may be completely out of reach. This is why housing is such a stubborn economic problem. It isn't one market. It's thousands of interconnected local markets operating under different rules. The consequences extend far beyond the real estate market. When people cannot buy homes, they rent longer. When they rent longer, they have less opportunity to build housing wealth. And when homeownership becomes concentrated among older or wealthier households, the gap between owners and non-owners can widen. The current numbers show just how persistent the problem is. The U.S. homeownership rate was 65% in the second quarter of 2026, essentially unchanged from the previous year. At the same time, housing costs continue influencing where people live, where they work, and whether they can remain near family. Then, there is the geographic effect. A worker may technically be able to afford a home somewhere, but that doesn't mean they can afford one near their job. So affordability becomes a transportation problem. A family moves farther away to find a cheaper house. The commute becomes longer. Transportation costs rise. Time disappears. And eventually, the cheaper house may not feel cheap anymore. This is how a housing shortage spreads through the economy. It affects labor mobility, family formation, savings, retirement, and wealth accumulation. The housing crisis isn't only about real estate. It's increasingly about who gets the opportunity to build financial security. So what does this crisis actually teach us? First, housing affordability cannot be measured by price alone. A $400,000 house can be affordable in one economic environment and painfully expensive in another. Interest rates matter, income matters, taxes matter, insurance matters, and supply matters. Second, building more homes matters because demand doesn't disappear simply because prices become high. Freddie Mac's research points directly toward inadequate supply as a major long-term driver of housing affordability problems. Third, investors are part of the story, but not the entire story. In the first quarter of 2026, investors represented about 19% of home purchases in Redfin's analysis of 39 major U.S. metropolitan areas. Investor purchases actually fell 6% year over year. That matters because it challenges a popular explanation. The future of American housing may not look like the past. There are reasons for optimism. By mid-2026, housing affordability had improved modestly as mortgage rates moved lower and inventory increased in many areas. Realtor.com's mid-year forecast expected home prices to rise only 1-2% during 2026, slower than inflation. But improvement is not the same as affordability. A market can become less expensive than last year and still be unaffordable to millions of people. That is the critical distinction. The next stage may depend on whether supply finally catches up with demand. More construction could help. Lower mortgage rates could help. More flexible housing types could help. And in some areas, smaller homes, accessory dwelling units, manufactured housing, and other alternatives could expand the choices available to buyers. But there is no single switch that fixes housing. If rates fall too quickly and demand surges, prices could rise again. If construction accelerates, affordability could gradually improve. If rates remain elevated, buyers may continue waiting. The future is therefore less about one dramatic crash and more about a slow battle between supply, income, prices, and borrowing costs. And that battle will determine who gets to own the next generation of American homes. For decades, Americans were told that owning a home was simple. Get a job, save money, buy a house. But the housing market of 2026 tells a more complicated story. The problem isn't that Americans suddenly stopped wanting homes. they still want them. Problem is that the path between income and ownership became much more expensive. Prices rose, borrowing costs changed, construction failed to keep pace with demand, and millions of existing homeowners became financially tied to the cheap mortgages they already had. Meanwhile, younger buyers entered a market where the definition of affordable had moved far beyond what their incomes could comfortably support. And that leaves us with a question bigger than real estate. What happens to a country when the asset that once helped ordinary families build wealth becomes increasingly difficult to enter because a home is more than four walls? It can be security, a financial asset, a place to raise family, and for millions of Americans, a foundation for the future. The American dream may not be dead, but it has become more expensive to enter. And until America builds enough homes that ordinary incomes can actually afford, the question won't simply be, why are houses so expensive? It will be, who will be able to afford America?